All right, let's talk Innodata's Q4 2025 earnings. This one's a real head scratcher. On the surface, the numbers looked absolutely fantastic. But the stock? Well, the market sold it off hard. So we're going to dig in and figure out exactly what happened. So here's the puzzle we're trying to solve. The company posts a massive 19% earnings beat, and the stock immediately tanks over 7%. How does that even happen? What did Wall Street see that the rest of us missed in those headline numbers? That's exactly what we're here to unpack. Okay, first things first, let's dive into the actual numbers that created all this confusion. Because, look, on paper, this quarter was a total knockout. And when I say knockout, I mean it. Just look at this. Adjusted EPS came in at 25 cents, absolutely crushing the 21-cent consensus. Revenue? $72.4 million, which is more than $3 million above what analysts were looking for. And that's 22% growth year over year. Even their gross margin at 42% came in nicely above their own target. You look at these metrics and you think, wow, this is a home run. And yet, this is what the market had to say about it the very next day, a drop of more than 7%. I mean, this wasn't just some minor profit taking, this was a pretty decisive move down. And you can see the conviction behind that move when you look at the trading volume. The stock sold off on 2.7 million shares traded. That's almost 2.5 times the average daily volume. That's not just noise. That suggests the big players, the institutions, were heading for the exits. So the real question is, what did they hear on that earnings call that spooked them so much? Okay, so now let's get into the real story management was telling. It all comes down to this big strategic shift with their largest customer, which, by the way, is both their greatest strength and their biggest risk. And you can hear it right from the CEO. He said they intentionally shut down, get this, about $20 million worth of older work. Now, that number sounds pretty jarring, right? But the key phrase here is, but replaced them. Management is framing this not as lost business, but as a strategic upgrade. They're swapping out old work for new, higher value programs, and they claim the net effect was actually positive. So here's their game plan, broken down into 3 simple steps. First, you get rid of the old, less valuable stuff. Step 2, you replace it with more complex, more important programs. Things like pre-training and scaled post-training. This is what they mean when they talk about moving up the stack in the AI world. And finally, step 3, you make sure that new work brings in more revenue than the old stuff you cut. It's a really compelling story about evolving the business. But, the market rarely trades on the past. It's all about the future. And when we get to the forward-looking guidance, well, that's where you start to see the cracks. And this guidance really presented a huge conflict for investors. On one side, you have this amazing projection, 35% plus revenue growth for the whole year. That's incredible. But, and this is a big but, there was a catch. To get that growth, they said their adjusted gross margins would have to dip, probably into the 35 to 40% range for a little while. And that's a pretty big step down from the 42% they just delivered. See, that dip in margins is basically the price of admission for ramping up these huge, new, complicated programs. And this, right here, is what the market sold off on, execution risk. It brings up a ton of questions. How long are margins going to be under pressure? Can they actually get them back above 40%? Investors absolutely hate uncertainty, and this guidance just injected a whole lot of it into the story. So let's zoom out for a second and put this all into the broader investor context. It helps explain why the reaction was so negative, even with those great headline numbers. So here's the breakdown of why the sellers won the day. For them, that near-term margin pain was just a bigger deal than the revenue beat. There's just too much uncertainty about how long it's going to take to get these new complex programs running profitably. Then you throw in a really weak software sector. I mean, the IGV Tech ETF was down 18% in the month before this report, and you have the perfect recipe for a classic sell the news event in what's already a pretty volatile stock. Okay, so that's the what and the why. Now, the big question, where does the stock go from here? Let's get to our thesis for the next quarter. This is the next call. We're rating the stock market perform. And what that means is we think it's pretty fairly valued right now. The bull case and the bear case are basically in a standoff. And because of that, we're predicting the stock is going to be range-bound. It'll probably trade sideways for a while, at least until the next earnings report. The market is basically in a holding pattern, just waiting for more data to prove whether management's story is right. So the core thesis really is this standoff. You've got the bulls, and they're laser-focused on that 35% plus growth number, betting this whole strategic pivot is going to pay off big time. Then you have the bears, and they're worried about the margin pressure and, frankly, the risk of having so much of your business tied to just one customer. All of this puts the stock squarely in a show-me phase. The next major move, up or down, is probably going to come right after the Q1 results give us a clear picture of where those margins are headed. So, if you're watching this stock, what should you be looking for? We've got 3 key catalysts. Number 1, and this is the big one, that margin trajectory. Any sign they're getting back toward 40% faster than expected will be a huge positive. Number 2, customer diversification. An announcement of any new major client would go a long way to de-risking the story. And finally, workflow stability. We need to see hard evidence that this new work with their biggest customer is scaling up just like they planned. And all of this leaves us with the big question. Is the market just flat out wrong here, underestimating Innodata's ability to pull off this really smart transition? Or is that margin pressure actually the canary in the coal mine, a warning sign of bigger problems to come? We'll find out a lot more next quarter.
All right, that's our breakdown. And as always, please remember, this is not financial advice.